FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz, and today is 11/26/19, just a couple of days before Thanksgiving, and I'm getting together with some friends here in Florida. I could have gotten together with family, but the idea of going through airports on the busiest travel days of the year just did not excite me much. What are you doing for Thanksgiving? There certainly is a lot to be thankful for, especially higher stock prices and ever ascending record highs on the indices. But will it continue? Well, let's do a little post-mortem. What do you think's happening with the markets? They going to melt up or are they going to melt down? That really is the question. And email us. The email address is kl@kerrylutz.com. Well, our good friend Eddie Ghabour is with us today, Key Advisors. And Eddie, things just keep getting better and better, don't they?
They really do. And you know, I've been on your show obviously several times over the last few years, and as you well know, I've been very bullish the last few years. Now, I will say this as a cautionary sign for investors: is don't get too euphoric of a state of mind that the market can't have small dips. So I would not be opposed to folks taking some profits right now, considering where we are. I still think the backdrop for the market, to your point, is still setting up nicely for a melt up heading in the year end, especially if we get some type of concession on tariffs for December the 15th. I think there's still more room to the upside. But again, as an investor, I think it's always prudent to take profits when you've seen huge returns like we have this year. But look, the Fed is off the table. We don't have to worry about raising rates anymore. Earnings have still been pretty steady, not as strong as they were, but certainly not pointing to a recession. And so the backdrop for equities is still good.
Mm-hmm. And according to what you sent me, what you wrote, pretty much this is in large measure still due to the tax cuts and everything that's happened as a result of them.
Look, I think one thing, whether you love them or hate them, in regards to the current administration in place, the equity markets really like what's happening from a regulatory perspective, from a tax perspective. And I think you're seeing this in the cash flow of these corporations, and you're noticing some mergers and acquisitions really picking up. There's talk that Schwab and TD may now become one company if that gets approved. I mean, I think you're going to see more and more of this, and I think a lot of it is due to the cash on hand that some of these corporations have. And I do think you still have to be conscious of corporate debt. Don't get me wrong. I think when you're looking to invest, you need to make sure that the companies you're investing in my opinion, don't have a huge amount of debt ratio on their balance sheets, because when we go into a recession eventually, those are the companies that normally struggle the most. But again, right now, the backdrop, too much to everybody's, I shouldn't say disappointment, but they don't, probably the most hated bull market in history, because all year we've heard nothing but recession, and the market just continues to be resilient and go up.
So you think the market is performing its function of being a leading indicator, and this is more of what we have to expect? And the other thing is, we didn't really discuss it much, but the fact is that that employment-wise, new claims for unemployment, the only statistic that hasn't been manipulated over time, they continue to stay at historic multi-generational lows. When you combine those two, what's the future?
Yeah, and see, here's the thing, too, with the U.S., and this is why I was debating many this year about a recession for 2019. I did not see it, and the reason why I didn't see it is we are a consumer-driven economy here in the U.S., and as long as the labor market stays as tight as it is, and we've actually seen wage growth, the consumer strength has been fantastic to watch this year. And so until you really start to see a major hiccup in consumer spending and consumer confidence, I think at that point in time, then you can start to worry about when we have our next recession. Now, look, you and I both know it's inevitable. It's going to happen. No one knows exactly when it is. I just didn't see the fundamental reason as to why some people were really slamming their fists on the table, saying that 2019 was going to be the year of reckoning from a recessionary perspective, when the fundamentals from a consumer perspective was so strong. I mean, the labor market's as tight as it's been in such a long period of time, and until that changes, I'm not overly concerned about a recession.
Hey, and all indications are it's not happening. We see housing, which is a crucial factor in figuring out the economic direction of the country, at the very least has stabilized, and in certain markets like Denver and outside of the go-go markets like New York, San Francisco, LA, and Miami, but smaller markets, they seem to be very strong.
It is. Look, I live in Delaware, and I can tell you I haven't seen a housing market this strong in a very long time. I mean, the demand, if you look at the building sector, and this is where we thought we would kind of get a pop heading into 2020 and some help from an economic perspective. If there is an issue with housing, is inventory, low inventory in certain price points. And that is a good thing, because that means that these builders need to build houses within that price point to meet the demand. And now that the fear of interest rates going through the roof, as we were having this conversation this time last year with the 10-year note, hitting highs that we hadn't seen in a while. Now you have a 10-year treasury at 1.75, 1.8. You have a Fed that's pretty much going to stay pat or reduce rates. That should help increase demand for housing as well, because mortgages are going to stay pretty low.
Hey, what about the inverted yield curve, which looks like it's uninverting now, but that's like always been a surefire sign of an impending recession, except when it's not, right?
Yeah, and look, I do put a lot of weight in that inversion of the yield curve, and I was concerned when I saw that happen, because I think the kiss of death is when somebody says it's different this time. Now, keep in mind, the inversion of the yield curve, when that happens, generally speaking, it could be 18 to 24 months on average before you do see a recession. So we may see some recessionary signs in the fourth quarter of next year or the beginning of 2021. But right now, again, here in the near term, which is why you're seeing the equity markets do what it's doing, all this negative news that was being priced in is being proven wrong with consumer numbers and with earnings that these companies are coming out with.
And that leads us to the next thing. What about the election? We've heard that it's the economy stupid. Is it still the economy stupid?
FSN Radio. It's all about what's next.
Silver One Resources is an exploration and development company backed by strategic investors Eric Sprott and SSR Mining. The company is focused on its Candelaria mine project in Nevada, where there is already a historic resource estimated at 127 million ounces of silver. The Candelaria mine historically was the highest grade silver producer in Nevada, generating over 68 million ounces of silver at an amazing average production rate of over 1,250 grams per ton. The project has tremendous expansion potential, as past drilling has outlined deeper, high-grade silver targets for future drill programs. Silver One is highly leveraged to the price of silver and is cashed up and poised to increase shareholder value. Silver One trades in New York under the ticker SLVRF and in Toronto under the ticker SVE. To learn more, go to silverone.com. That's silverone.com.
The Financial Survival Network. It's all about what's next.
I would think that will probably be the case, but I think next year the biggest risk to the equity markets is going to be the headline risk you hear as you get closer to the election. More than likely, probably in the summer months, when it starts to get really nasty from a political perspective of all the mudslinging that will be going on. I think there could be some increased volatility due to certain headlines that you will see. But I do think at the end of the day, as a voter, when you get behind the booth, it is of my opinion, in talking to various people, no matter what party they support, that they're going to vote for what has helped their family financially the most. And if they feel this environment has been very beneficial to their family, my guess is they'll vote to keep the administration. If they feel like this current environment has not been beneficial to their family, then they won't vote for this administration. So I think at the end of the day, people are going to vote with their wallet.
They vote with their pocketbook. That always has been the most important issue, Eddie. Hey, so you're in Delaware, and your favorite son there is making another go at the presidency. A lot of dirt coming out about him. Uh, what's your man on the street perspective of how this is being perceived in your home state?
He has a lot of support in the home state. Make no mistake about it. You can just look back at the history of Delaware and how Delaware votes. So he definitely has support here locally. The hometown guy, for lack of a better word. I just think right now it's too early to tell who's going to be on the Democratic ticket, frankly. I mean, you've got Bloomberg just jumped in. We have no idea what that's going to impact things. Some of the polling that you're seeing are all over the place. I'm glad I'm not in the business of politics and having to predict these things, because it's probably easier to help predict the market on a short-term basis than it is elections, just because you don't know what polls are accurate and which ones are not. And I don't think finding out the nomination is going to be an easy task. I don't think it's going to happen soon, actually, because of how tight the race is, which is probably a surprise to the Democratic Party, I would guess, because I'm sure, based on things that I've read, that Biden was probably considered an absolute shoo-in and is probably surprised about how tight the race is in certain states.
Mm-hmm. So, but in spite of all the political stuff, the market keeps going up, and that's pretty shocking, which shows the consumer confidence, your individual belief in the solidity of this economic recovery is pretty high.
It is. And so it's comforting from a market standpoint when you see the stock market reacting to fundamentals, not to a news story. Okay. Because at the end of the day, that's what can make it challenging for an investor in making decisions. There's so many distractions out there. And sometimes you can scratch your head and say, well, the fundamentals look good, but the market's not performing as it should. And it's because of its reaction to headline risk. Frankly, I think the market is numb to all of the headlines that could be perceived so negative from a stock market standpoint, because anytime we've seen that here this year, and then earnings reports come out, consumer reports come out, and it defies all the headline risk that had the market scared. So it's actually comforting that one headline or one news report isn't causing the market to drop by 300 or 400 points.
So you mentioned the tariff situation. Now, Congress has just passed a bill in support of the dissidents in Hong Kong and the People's Republic of China. China's reacted very negatively to this bill. We don't know if Trump is going to sign it yet, but overall, the noises coming out of the White House are supportive of the Hong Kong protesters. Do you think the word of a trade deal between the U.S. and China is entirely, shall we say, a little takeoff on Mark Twain's old saying, "Reports of my death are entirely exaggerated"? Do you think that the reports of the trade deal are exaggerated?
The one thing with the trade deal is I still do not believe, frankly, that we're going to get any type of comprehensive deal before the election. And the reason why I say that is the Chinese, in my opinion, if you're sitting on their side of the negotiation table, really have, at this late in the stage of the game in 2019, they really don't have much incentive to sign anything, considering the fact that the U.S. has an election in 12 months from now. So from their standpoint, they may be thinking to themselves, well, maybe I'll have a new president that may be a little bit more lenient, that I can sign some type of negotiated deal at that point in time. So I think the best case scenario we see here is some type of phase one deal with tariffs being taken off the table for the December 15th tariffs. I think if we just get that is going to be enough to cause the market to carry the momentum into next year. If we see some type of major disruption in that phase one negotiation and the administration does put on the additional tariffs on December the 15th, then I think you'll see volatility naturally to the downside. But at the end of the day, both parties, I think, need or want some type of truce or phase one agreement, and it's in everybody's interest for that.
Yeah, agreed. Well, the one thing, though, is when we look at this, we say, trying to be objective about it. it's really, yes, it could be more to their advantage to basically wait. But then again, if Trump is reelected, it could be greatly to their disadvantage, couldn't it?
Oh, without a doubt. Then I think all of the leverage goes to the Trump administration. So that's why I think they're going to, in my guess, they'll take a calculated risk and agree to portions of a trade deal. Because, look, I mean, the Chinese economy has really suffered a lot more than we have in this whole trade war going back and forth between the U.S. and China or during these trade negotiations. And again, this is an area that I think a lot of people were wrong, where they thought we were going to see these huge spikes in inflation and really hurt us with this happening. And frankly, we don't really see it. I think one could agree that if you're looking at it objectively, that China has really suffered a lot more from this than we have.
Yeah, for sure. And they need the food right now, right? Their pork herd, their pig herd hogs are really down because of the flu. All these things have occurred that we weren't really expecting. So I find the whole thing kind of fascinating. So when we're talking next year, what do you think the main trends for next year are going to be?
You know, again, I think the first half of next year is going to be about fundamentals. It's going to be how the 10-year Treasury and interest rate market reacts to economic data. I think the trend will continue to be upwards in the first half from an equity perspective, not without volatility, though. Like I said, when you have had a run-up with several weeks like we've had here, you have to expect a 6 to 8% drawback. But that is a pretty normal expected drawback within a calendar year. And I would look at those as buying opportunities more than anything, unless something fundamentally changes on the consumer or labor market, which I just don't see anything changing that quickly. I think the second half of next year is really going to be all about the election and what type of policies are the two parties that are going to be representing on the ticket, are they pushing on their agenda? And is it pro-business or not pro-business? And that's why I think the second half of next year is going to be more about the election than it will be a fundamentals of what's happening at that moment.
Interesting. So I guess we're just going to have to sit back, see what happens. Hey, people want to find out more about you, Eddie, see what you're doing these days. Where's the best place to go?
They can go to our website, which is keyadvisorsgroupllc.com, and they can also follow me at Twitter. My Twitter handle is @CommonSenseBull.
All right. Excellent. And we'll have a link to your site as always. Our site, financialsurvivalnetwork.com. Check it out. Sign up for our newsletter. Twitter handles @Kerry Lutz, Facebook page, Financial Survival Network. Eddie, thanks so much. Have a great Thanksgiving. We'll talk to you again real soon.
Same to you. Thank you so much for having me on your show.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.